For many stores across Europe, it may not be business as usual this year. European officials say they're lowering the growth forecast for the Eurozone by nearly half a percentage point.
EU's GDP is expected to grow by 1.1% in 2025 and 1.5% in 2026. The euro area economy is expected to grow by 0.9% this year and 1.4% next year.
One of the main reasons for the slowdown is the weak performance of powerhouse economies like France and Germany. Together, they make up almost 53% of the Eurozone's total GDP. The French economy grew by just 0.1% in the first quarter of 2025, primarily due to stagnant household spending and declining investments. In Germany, the economy is struggling with high energy costs because of Russia's war in Ukraine, as well as structural issues like low industrial competitiveness. Officials have also expressed pessimism about future growth, blaming Donald Trump's trade policies.
As it is already known, we will have to lower the forecast once again by 0.3% for 2025 to 0%. That means we predict stagnation for this year. For 2026, we are lowering the forecast from 1.1% to 1%. There is one main reason for this, namely Donald Trump trade policy.
Growth in the Eurozone has been lackluster since 2024, falling from a peak of 0.4% in the third quarter last year to 0.3% in the first quarter of this year. Another key factor behind sluggish growth is persistently high inflation. Inflation did fall from its peak of 2.6% to 1.7% in September last year, but it has hovered between 2.5 to 2.2% since then, still above the European Central Bank's 2% target. With inflation at those levels, consumers are cutting back on non-essential spending. And to tackle rising prices, the European Central Bank raised interest rates aggressively. They only started to reduce them from their peak of 4.5% in May last year, and they're now sitting at around 2.4%. But after such a prolonged period of high rates, the cost of borrowing remains steep, making spending more difficult for both households and businesses. Emre Boz, TRT World.